Coming up today, stocks pull back on the back of the Fed's new forecast, the monster triple witching tomorrow, can Nvidia impress Wall Street, the latest moves from global central banks, and how you can now own a piece of SpaceX with a new ETF nobody's talking about. You don't want to miss this one, guys. Let's go. And welcome back to Click Capital, everybody. On another soft day here in the market, all the indices finishing lower with a bit of checkered breadth looking underneath the surface. No real big moves either way. Market seems to be coiling up, going into a monster triple witching tomorrow. The last expiry of Q1 2025. Options, futures, all set to expire tomorrow afternoon to the tune of $4.5 trillion. So we may indeed get the big move in the market tomorrow. And stick with me because I'll show you the charts later on and what the volatility market is predicting for tomorrow as well. I'm also proud to announce I'm now indirectly a part owner of SpaceX via a new ETF on the market that recently bought shares in the still privately held SpaceX company. And no, this isn't the Destiny 100 fund that trades at a huge premium over NAV either. Nobody's talking about this new one. I just happened to stumble upon it yesterday. So stick with me today and I'll show you later on in this video what it is, along with my bullish thesis on it and why I made an investment in it today. And if this is the kind of stuff that you enjoy, please let me know that by clicking on the like button and subscribing to this channel if you haven't already. And I'll keep sharing my investments with you guys if this is the kind of stuff you enjoy hearing about. But first, let's just take a look at the market, along with some data and headlines. The way I see it, the market is so lopsided with bearishness, fear, uncertainty, pessimistic sentiment. The first piece of good news we get, especially if it's some positive developments on tariffs, I think the market is ripe to rip hard on the upside in a big monster volume day. But of course, it's day to day with tariffs and the headlines we're getting. Still think the underlying fundamentals of the market and economy are holding up pretty good. Exciting stuff with AI and robotics. The ingredients are there for a big rip. Once the market can really shake off these tariff fears that are still plaguing the market here, we seem stuck in the extreme fear zone. In addition to the AAPL investment sentiment survey, now being over 55% bearish readings for a month straight. Still in the high 50s here today. And so I think we get big global tariff deals done this year or next year at the latest. Because if markets and consumers are still on edge going into the American midterms, I think the White House will look to get something done to try and retain power going forward. Hence, they're moving quickly now, try and get to it all very early on. Like I said, before we hit the midterms, where there'll be a lot more political pressure to patch things up. The good news is already, European Union has already delayed its first round of retaliatory tariffs by a couple of weeks, giving a bit more time to allow for negotiations potentially. But for the here and now, investors by and large are some of the most bearish we've ever seen, typically associated with bear markets or financial crises. And typically looking back in history, maximum fear makes for good entry points and forward returns. And that's because future uncertainties are almost always overpriced in the present. And so looking back in history, when the AAPL bearish sentiment reading 4-week average exceeds 57%, the few rare times that's happened before, we're higher. A week, 2 weeks, month, 2 months, 3 months, 6 months, and a year later, 100% of the time, and with very good forward returns. Looking at a year, that's more than 3 times the average 12-month return in the market. And on the other hand, it's not all that unusual to see a bit of chop here in year 3 of the bull market. We just had 2 good years, up more than 20% in each of the prior 2 years. Year 3 of a bull market tends to be choppy, then we get back to business come year 4. That also coincides with the presidential cycle. Like I said, we can see a bit of volatility in the midterms. Pick back up in year 3. Year 4 is typically the best, which was last year. And then looking at this pattern when we have a down midterm year, once again, we can consolidate Q1, Q2 in the first year of the new presidential term. But just looking at the here and now on typical seasonality for the month of March, we're right around here. And so the rest of this month very well may follow seasonality, especially we did get so oversold up until about a week ago. Going into the end of the quarter, there very well could be large funds doing massive rebalancing, buying stocks, selling bonds. And like I said, if we got a bit of positive news in tandem with that, it could really light things up here. However, a lot of people are still convinced this is the start of a new bear market or we're on the cusp of a recession. And even though that's possible, anything's possible, it's not probable. As only 13 of the previous 39 10% corrections in the market did go on to become a bear market, technically defined as coming down more than 20% from highs. We're not only at extremes when it comes to bearish sentiment, but also in CTA positioning. That's fund managers. And what you're looking at here is a spread between the States and Europe. Not only at the lowest reading going back over a decade, but also the sharpest move as well, going from plus 70 to minus 85. And typically sharp moves in the markets, no matter the asset or even spreads, can quite often quickly correct as well. And so what you're looking at here is a spread between the S&P 500 and European stocks ETF, FEZ. That was the day after the election right there. the 6th of November. Ran up for about another 2 weeks, then it's just absolutely fallen over. And let's just go out to a weekly chart to kind of get a better look here. Technically speaking, very stretched, along with my reversal signals indicator firing off, whilst we're at the bottom of the buy-sell band, indicating this move could be potentially exhausted or nearing exhaustion, just like we saw back here and back here. But like I said, we've seen these moves before, but this one very sharp and swift. And that's because a lot of investors, even large institutional investors around the world, have bailed on US stocks in what's essentially a bet against the new admin, as they believe they'll find better growth in Europe, with their economies still flirting with contraction. But it's not only global investors that have dramatically changed their forecast and positioning based on the new admin, it's also the Federal Reserve. As I predicted last year before the election, Jay Powell would dramatically change his tune with the new president. So he too is doubtful, skeptical, uncertain about what all these new tariffs are going to do. Like I said, it seems to me it's largely a foregone conclusion that they're going to be bad. Market almost pricing in a good chance of a recession, setting up for a big upset if it doesn't happen. Because looking at the key ingredient for a recession, with the latest Goldman Sachs US consumer dashboard, looking at 6 key categories: spending, employment, income, wealth, debt, and confidence, with an average score. Green being good, yellow being average, red being bad. So definitely we can see here confidence at the 37th percentile isn't all that great, and that's typically what we see during a recession. But spending's still pretty good, well and truly in the top end of its range, 78th percentile. Along with the jobs market employment, income's a bit below average, wealth's pretty much at all-time highs. But what's really different about this time, prior to last recessions, is debt. Consumers' households are not levered to the gills like they were back in the mid-2000s. Thanks to subprime lending, no doc loans, a massive overcapacity in the housing market. Currently at the 89th percentile, and that's because consumer and household debt relative to their income, relative to their wealth, relative to GDP, and also relative to the US stock market capitalization is actually near all-time lows. And so prior to the GFC in 08-09, that was really red going into that. Similar deal in the early 2000s, and back in the late 80s, going into the early 90s, we had a recession back then as well. So overall, things are holding up pretty good in the ones that matter the most, because you can see back here in the GFC, it was really debt that was flashing the red light going into that. Whereas a lot of consumers weren't feeling all that great going well into the 2010s there. It did take a few years for the jobs market to fully recover as well. But income doesn't have those big trends, kind of flickers back and forth a lot. Same with spending. And so we just did get a bit of housing data. Home sales actually came in better than expected, rising 4.2% last month, and overall holding up pretty good. This rate hiking cycle that stopped nearly 2 years ago didn't really topple the housing and stock markets like a lot of people widely expected. And so the market is still pricing in a soft landing. Economic growth, GDP, and corporate earnings, EPS, are still in very healthy ranges and expected to stay so for the remainder of this year, whilst inflation has been coming down and the market even thinks we're going to get 2 or 3 cuts this year. Still pricing in odds the Fed will cut in June, for which it looks like the 2-year bond yield is pricing in the same. Fed's currently at 4.25, the 2-year just under 4%. The bond market thinks the Fed's next move will be down, and I think so as well, which is good news for stock investors when the cost of capital comes down for businesses and the relative attractiveness of stocks versus bonds goes up. But it's not just consumers that are a little unsure about what's going on now. It's also investors, just looking at the price action and reaction to news coming out from arguably the most important stock in the market, the leader of this bull market, Nvidia, still making its way through its AI conference, unveiling some pretty cool stuff, for which the market's given a bit of a muted reaction, just kind of trading sideways on low volume here, like it's waiting for something. Like I said, the ingredients are there for a big rip if the market can just shake off these tariff fears. And if we were to get a big headline with Canada, Mexico, China, ultimately all three, I think we could see a 5% day in the market. Because like I said, when the market's so lopsided, everybody leaning to one side of the boat, any headline that goes the other way, the algos absolutely pound that, catching everybody off guard, causing stops to be hit, short covering, and we get that change of narrative almost overnight. And that may not happen for a little while, but I expect at some point that it will. But just getting back to Nvidia, Jensen Huang just came out and said they're planning on spending hundreds of billions of dollars to create massive AI infrastructure and manufacturing on United States soil. Whole industry is getting together with the government on this to retain their global lead in AI. And this was on top of what we heard this week, them announcing Isaac GR00T N1, the world's first humanoid robot foundation model. And because they're making it open source, this is really going to accelerate humanoids and robotics. Nvidia pretty much creating the platform for developers to build upon, connecting their hardware with Nvidia chips and software. And that's why Jensen Huang is excited about this, because he knows this is the next step for his company, the next big monster multi-trillion-dollar opportunity. As he said, the age of generalist robotics is here, even creating an entire day at his conference dedicated for humanoid developers. He is betting heavy on this being the next big thing, and I'm happy to join him on it as well, investing in a number of robotics companies myself. As he also just came out and said, humanoid robots will soon join the workforce with factory work soon. And Nvidia is currently at one of its best valuations it's been at in years. In fact, this entire bull market got a forward PE at 25. And if we were to get a further dip, I would love to pick up a few shares at 103. I think would be a great opportunity if we were to get down there over the coming weeks, and represents a good yield for my money going forward. 4% yield next year, that very well could turn into a 6% yield come 27 and keep on growing into the late 2020s as well. But like I said, stick with me because I'll show you the new ETF soon with its largest position actually in shares of SpaceX, which I just invested in today. But first, just a few more stocks and headlines catching my eye today I wanted to share with you guys. Berkshire Hathaway, Warren Buffett's stock, just broke out again to a brand new all-time high today, $528 a share, market cap $1.14 trillion. Now this has definitely been a bit of a place to hide out throughout this market rout, and I can see why the appeal to many investors out there, big and small. As it's been overly reported, Berkshire Hathaway has $330 billion in cash. So obviously that's appealing to investors in these times of uncertainty. You can kind of think of Berkshire Hathaway as an ETF focused on American companies with a really low management fee that also has a sizable allocation to cash. But keep in mind, their cash allocation is actually less than 30% of their market cap. And as Buffett said himself recently, most of Berkshire is still invested in equities, as it always will be. And he also said most people are misinterpreting his cash position as trying to time the market. So what happens not if, but when they put a lot of that cash to work with their next monster acquisition? I think it'll totally flip that narrative that somehow Buffett is out of the market or he's short the market, when that's not how he's thinking about it himself. He's just happy earning 4.5% yield risk-free on a lot of cash. But what happens if the Fed cuts rates a couple of times? And if the market were to pull back even another 5-10%, it may just set up the perfect conditions for him to fire off his elephant gun, as he calls it, one last time, before calling it a day on an illustrious investing career. Moving on, also catching my eye today, Wynn Resorts, global casino operator, operating the Wynn in Vegas, Encore, also has 2 Wynn's in Macau, China, their gambling island, and is also expanding with the construction, the Wynn Al Marjan Island in the United Arab Emirates, scheduled to open in early 2027. But despite these growth prospects, Wynn trades at a bit of a discount here, probably also due to worries about the economy, consumer confidence. Currently at a 50% discount to its average trailing 5-year price to sales ratio and forward PE ratio as well. And we've also just had 2 directors on the board purchase $2.2 million worth of stock a couple of weeks ago, and they paid around $92 a share here as well. And they did just come in with a bit of a monster beat in their recent earnings, with a good push up after that. Now we're getting this low volume pullback, which may not gap fill down to that earnings day, around $80 a share. So I think this one's an interesting opportunity. And with a market cap of only $8.8 billion and one of the most recognizable luxury brands in global gaming, I think that's good value. And just before I get to SpaceX, quickly flicking through some global macro news. People's Bank of China kept their rates on hold as well, 3.1%. Same with the Bank of England, staying on hold, citing global trade uncertainty as intensified. They got their benchmark rate at 4.5%, but the Swiss National Bank actually trimmed by 0.25 point, citing low inflationary pressure. Seems like global economy and central banks are all kind of in this wait and see mode with a little bit of dispersion in inflation. Parts of Europe pretty soft, but we've got still some persistent inflation in Japan. Global bond yields by far and large holding up pretty well, as our global stock markets, and oil as well, getting a little bit of a bump up again here today. Nothing too significant, but I think this is still good news for inflation. Inflation can quite often lag behind crude oil, the biggest leading indicator of inflation. But once again, seeming to defend this big $66 support level. And the commodity I said a week and a half ago looked to be a good buy the dip, uranium, just touching its 50-day VWAP there today, with gold still sitting at all-time highs here above $3,000 an ounce. A little bit of a pullback in silver just after touching those 52-week highs, and miners still holding up there as well. They've been working really well this year and still stumbling around a little bit. Crypto, even though one could easily argue the fundamentals are there and improving for it, we just heard the president reiterate today that America will be the Bitcoin superpower and that they're committed to dominating crypto and financial technologies. Especially with his family heavily involved in crypto directly, it's hard to see the political and regulatory environment, with the whole admin stacked with crypto bulls. Not having a strong tailwind for this industry. It's got everything it needs now to flourish. But like I said, the price action's still a little soft here. Plenty of up and down. Seems every time we get these good rallies, just falls over the next day, just like yesterday and today. Do have a little bit of good bullish seasonality the next week or two, but looking at Ethereum, it's got plenty more work to do. Needs to string together a couple of fat green candles here, get above the 50-day for the first time this year. And just looking at the total crypto market cap, 2.7 trillion. This could still be defined as an extended pullback in a bull market. It'd really have to take out the lows from the prior consolidation to make an argument otherwise. But like I said, this market especially can turn on a dime. And when we eventually get that good news, I think it'll just open the floodgates for this to come back to highs as well. And that could happen even in a matter of days, week or two. Okay, onto what I promised at the start of this video. I'm going to share with you guys a relatively new ETF that owns shares in SpaceX that I invested in today. Really excited about this. I think it'll be a core holding of mine, at least until SpaceX comes onto the market itself, and potentially beyond that as well, because I like the strategy of this ETF and the company behind it, its holdings and management fee. So the fund manager is Entrepreneur Shares, relatively new niche player in ETF management. And their ETF is the Entrepreneur Private Public Crossover under ticker symbol XOVR. And so they recently just added SpaceX as their largest holding. First getting in December and then making another investment in SpaceX in January. And I kind of just stumbled upon this by accident, as I haven't really heard anyone talking about it, nor has it been in the news. And that's not to be confused with the Destiny Tech 100 ETF, ticker symbol DXYZ, which also owns SpaceX, but it trades at a huge premium to NAV. Its net asset value, 532, currently trading at 39. Did get up to high 70s there late last year, after the market really caught on to it in early November. It's had a monster run up since prior to that. But the good thing about this ETF is it actually trades right at NAV, meaning the mark-to-market value on SpaceX is the same as it currently trades on the market. However, like the name suggests, it blends private and public equities into one fund. And regardless of their SpaceX holding, I like the underlying strategy, focused on their proprietary Entrepreneurs Index of large cap US stocks. And so this fund was previously under ticker ENTR, but they've switched it. They've switched the strategy. And like I said, they just recently added SpaceX to their holdings with a very reasonable, if not, I'd say actually cheap for a niche fund with SpaceX gross expense ratio, 75 basis points, only 200 million assets under management, meaning the street investors at large have yet to discover this. 32 holdings. And like I said, SpaceX is their largest holding, just under 11% there. And since the fund focuses on investing in companies run by the world's best entrepreneurs, it's also got holdings in Alphabet, Meta, Nvidia, Oracle, DoorDash, and quite a few others. These are all some of the best businesses in the world, run by the most talented people and set to benefit the most from future industries. So I really like that strategy to begin with, and then having its biggest position as SpaceX just offers up that unique opportunity for us retail investors to gain exposure to what's possibly going to be the biggest IPO of our lifetimes, and also maybe the most consequential company of our lifetimes as well. Already doing amazing work rescuing those astronauts from space, stuck up there for almost a year. Of course, the mainstream media doesn't really want to report on that. And for those of you who don't know, SpaceX was founded by Elon Musk in 2002, absolutely revolutionized the aerospace industry with its development of reusable rockets and cost-effective launch solutions. The company's valuations had significant growth, last valued at $350 billion a couple of months ago. They made space travel dramatically cheaper, more accessible, and commercially viable, getting into space 90% cheaper than what NASA did. And so like Elon says, the main goal of SpaceX is to help make humanity multiplanetary, extend the light of consciousness, as he says. With plans for crewed Mars missions by the end of this decade, even potentially talking about sending Optimus bots to Mars come 2028. And whilst ambitious, success here could unlock government contracts worth billions and billions and open up a whole new multi-trillion-dollar industry. Space travel, missions to Mars, lunar missions, and further beyond that. But the real cash cow at the moment for SpaceX is Starlink, which you could kind of think of as a global internet provider, allowing people all around the world, previously in rural areas where they couldn't get online and connect with the rest of the world, the ability to do so. They've launched more satellites than every other government and company combined. 6,000 now in orbit, but it's still a small business. They've only got 4.6 million subscribers, but it is growing really fast, pretty much doubling from 2023. And to put that into context, Verizon, one of the state's largest telecom providers, has almost 150 million subscribers. Starlink's a global business, on track to do 20 billion in revenue just this year alone. So that's the bullish thesis on SpaceX. And this is the ETF that recently just added it to its holdings and changed its name and strategy back in December. Hence, we can see all the volume come in there. But the good news is it's pulled back ever since it's added SpaceX. Currently trades at NAV with no premium, unlike the Destiny 100 fund. And hence why, as soon as I discovered this, I opened a position in it today. I plan on holding it until SpaceX comes onto the market at least. Otherwise, I think the underlying strategy is a good one, potentially for a core holding, investing in the companies of the world's best entrepreneurs. Looking back in history, those companies have delivered exceptional returns for investors. And there are other space-related ETFs on the market that don't own SpaceX but own space-related public equities, like the ARK, Space Exploration and Innovation ETF under ticker ARKX. And just looking underneath the hood of this fund, does have global exposure, mostly in North America, and there's a look at its top 10 holdings. A few defense stocks, Rocket Lab, Archer, Palantir, but also with some questionable ones that are not really focused on space, like Amazon. Then there's another one, the Procure Space ETF under the ticker symbol UFO. Very small. Assets under management, 67 million. And there's a look underneath the hood at this one, a bit more globally diversified and a bit more focused on global communications. Kind of hard at this stage in the very nascent space industry to get a pure play on it. But for me, this Entrepreneur Shares private public crossover ETF is going to be the one I'm going to stay invested in, likely for a few more years to come. And I think it's pretty cool that us retail investors can now indirectly own a piece of what I think could be the most exciting company of our lifetimes, SpaceX. As usual, this is not financial advice. Please do your own research. I'm just sharing my thoughts and opinions with you. And like I said, if you appreciate this kind of stuff, I'd love it if you click that like button and subscribe to this channel. That lets me know that you enjoy this type of content. And if so, I'll keep making more of it. Otherwise, just wrapping it up here, just looking at the volatility market. VIX did close under 20 again today. And whilst the VIX term structure is still somewhat flat, we are getting back to a bit of a normal state of contango. In fact, now I've got the front month just a smidge underneath the second month. So that's a good sign. And the more we hold up here, the more a bullish divergence will develop. And like I said, even though it wouldn't be all that surprising to get a retest, who knows, potentially tomorrow on triple witching can get big moves on Friday. Should be a lot of volume coming into the market. Option dealers got the VIX 1 day at 18.5, which is actually a point below the VIX 30 day, but still reasonably high. And the markets have kind of done a soft little low volume bounce here. So we may get a move tomorrow out of this calling up. Otherwise, next week, I think we could see something end of quarter, a lot of volume coming in. And with that, that's pretty much a wrap for today. I hope you enjoyed this video and I look forward to making you another one this time tomorrow. Cheers.